Hey squad, and welcome back to my YouTube channel. I am Yuri Tochila, and let's get started. Today we are diving into the basics of payback period, walking through its calculation and exploring how it differs from management horizon. What is payback period? The payback period is the amount of time required to recover the initial investment of a project. It answers the question, how many years until we break even? The formula is payback period equals initial investment divided by annual net cash inflow. Organizations often prefer projects with shorter payback periods because investment risk is lower, financial returns arrive sooner, capital can be reinvested faster. Payback period is frequently used during early stage financial evaluation because it's simple and easy for stakeholders to understand. However, it's important to remember that payback period focuses only on how quickly the investment is recovered, not on the total profitability of the project. What is initial investment? Initial investment answers the question, how much money must the organization spend before the project starts generating benefits? Initial investment typically includes three categories. Capital expenditures, CapEx. These are one-time costs required to acquire long-term assets needed for the project. Examples: equipment and machinery, servers and hardware, infrastructure, software licenses or platforms. Project execution costs. These are costs required to deliver the project. Examples: internal labor, external vendors and contractors, systems integration, custom development, testing and deployment activities. One-time implementation and readiness costs. These are expenses required to make the solution operational. Examples: training and onboarding, data migration, change management activities, initial configuration and setup. Together, these elements form the total initial investment used in the payback period calculation. What is annual net cash inflow? Annual net cash inflow is the net amount of cash a project generates each year after additional operating costs are considered. These inflows usually appear in two main forms: direct cash inflows, revenue gains. This is new money generated because of the project. Examples: increased sales from launching a new product, additional subscriptions after improving a digital platform, new customers gained after expanding services. Cost savings. Sometimes projects don't generate new revenue, but instead reduce existing costs. Examples: lower energy expenses after installing solar panels, reduced maintenance costs after replacing outdated equipment, less staff overtime due to automation software. Both revenue gains and cost savings contribute to the annual net cash inflow used in payback period calculations. Let's contextualize this using an example. Suppose a project requires an initial investment of $100,000. Once the project is operational, it generates $40,000 in new annual sales, $10,000 in annual cost savings. Annual net cash inflow equals $50,000. Payback period equals 100,000 divided by 50,000 equals 2. This means the organization will recover its investment after 2 years. After that point, the project begins generating net financial benefit. The simple payback formula works only when annual net cash inflows are equal each year. However, in many real-world projects, annual net cash inflows vary over time. Some years may produce higher returns, while others generate less. In these situations, we calculate payback period using the cumulative method. Step 1. Identify the initial investment. Example: initial investment equals $100,000. Step 2. List the annual net cash inflows. Example: year 1 equals $20,000. Year 2 equals $30,000. Year 3 equals $40,000. Year 4 equals $50,000. Step 3. Calculate cumulative cash inflows. Year 1 cumulative equals 20,000. Year 2 cumulative equals 20,000 plus 30,000 equals 50,000. Year 3 cumulative equals 50,000 plus 40,000 equals 90,000. Year 4 cumulative equals 90,000 plus 50,000 equals 140,000. Step 4. Identify the year when cumulative inflows exceed the initial investment. At the end of year 3, we have recovered $90,000. The project still needs $10,000 to fully recover the investment. The recovery occurs during year 4. To estimate the exact payback point, we use interpolation. At the end of year 3, cumulative cash inflow equals $90,000. Remaining amount to recover: 100,000 minus 90,000 equals 10,000. Year 4 inflow equals 50,000. Fraction of year 4 needed: 10,000 divided by 50,000 equals 0.2. Final payback period: 3 plus 0.2 equals 3.2. This means the investment is recovered approximately 3.2 years after the project begins generating returns. Important considerations. Although payback period is useful, it has several limitations. It ignores the time value of money. $1 today is worth more than the same dollar received in the future. That is why more advanced metrics, such as net present value, are often used. It ignores cash flows after the payback point. A project may recover its investment quickly, but produce limited long-term value. Shorter payback periods reduce risk. The organization recovers its capital faster and can reinvest it in other opportunities. For this reason, payback period is typically used as an initial screening tool rather than a final investment decision metric. Finally, let's look at management horizon. Management horizon is the time frame in which leadership expects to see results from investments. For example, executives might evaluate projects within time frames such as a 3-year horizon, a 5-year horizon, or sometimes even longer. Organizations often prefer projects where payback period is shorter than the management horizon. For example, if the management horizon is 5 years, leadership may prioritize projects that recover their investment within 3 or 4 years. Projects with very long payback periods may be rejected because they tie up capital for too long and introduce greater uncertainty. In simple terms, payback period is a financial calculation. Management horizon is a strategic decision boundary used by leadership. Understanding both concepts helps project managers participate more effectively in project selection and portfolio prioritization decisions. Alright, that's all for today. Don't miss out, hit like and subscribe. Stay awesome and as always, peace.